Hello, in this video, we're going to explain the difference between an LCC trade and an LCP trade. Both an LCC and an LCP are what we call LCO trades, leaps covered options. An LCC is a leaps covered call, and an LCP is a leaps covered put. So the difference we're going to show you here today is, let's show an LCC. An LCC is actually a bullish to neutral position. So we want the price of the stock to increase. And this is like a covered call, but we don't actually own the underlying. We actually are going to buy a long-term leaps option in January 19 here. So that is 299 days out. And then we'll own that leaps, and then we can actually sell calls against it and make income that way. So with this AMTD and an LCC, what we're going to do is buy a long-term leap here, and we want that leap ideally to have a delta of 0.70 to 0.80, and then when we sell our call against it, we want the delta to be about half of what the long delta is, the long call delta. So with this AMTD, let's say 47, that's 77 delta. That would be a good choice there, that 47. And then we would go up here and we'd look for a call to sell against it. And it looks like the 59.5 would be a good choice there. So let's go ahead and set this up as if we're creating this trade. We're actually this is a buy because it's actually a debit spread diagonal. So we're going to buy the diagonal. We're going to change the long to January 19 here. And we're going to choose the 47. And for the short, we're going to do May. And we're going to do the 59.5, we decided. Okay, and then here's our other check here. Now we want to make sure the difference in the strikes is greater than the debit we're going to pay. That way we will actually make money if we're called out on this loan. So it's 12.5 here. We're going to pay 11.09. That actually would work and would be a good LCC trade. Okay. Now the LCP is a bearish to neutral position, and we're just doing the opposite here. We're going to buy a long-term leap put with a delta between 0.70 and 0.80. So let's go see what we can do with, this is a CL. We actually had a CL position this week, and an LCP would be a good example. So what we're going to do here is an in the money put. Let's go with the January 19, looking for a delta between 70 and 80. We ended up taking the 77.5. And it's a 7.8 delta, and we want to find a short put to sell with a delta around the half of that 78. So we would look for, we actually sold the 67.5 because the delta was at the time was around 38. But that makes up the LCP. Well, this is a bearish. We want that stock to go down. And ideally, we want to get a gain of 5 to 10% as quick as we can, hopefully within the month, and then just close out the spread. If it doesn't go down, we can buy back that short with the LCP and then resell the put again when the price does come down. So that's the difference between the LCC. LCC is bullish, LCP is bearish, and we're buying a deep in the money long-term option, and we're selling a short-term option against that long since it's covering. The long is covering the short.